folks, Rick Wedell here. I'm the Chief Investment Officer at RFG. Thought we'd come to you today with a brief market update, kind of let you know what's going on out there. S&P 500 is right at 4167 as I'm speaking, and we are now out of the correction territory that we entered last week. So to give everybody a brief market history, market kind of peaked right around January 1st of 2022, had a classic 9-month bear market down to about September 30th of 2022. We then saw the market rally right up through about the middle of this year, enter into the next bull market phase. And then more recently, in the past few months, we've seen a sell-off which culminated late last week with the S&P 500 being back down 10% off its most recent peak, which puts us in correction territory. So for those of you keeping score at home, a little bit of a roller coaster ride over the last 18 to 24 months, but we are out of correction territory now and just below that 4,200 number that we talked about earlier. We'll talk a little bit about why in a few minutes. First, I just want to touch on earnings season. We are in the middle of earnings. Normally, stocks are very, very, very focused on earnings. I think this season they're a little bit more focused on the macro data. We so far had about 264 companies report within the S&P 500. Earnings have come in at plus 6% year over year, which is quite strong, certainly strong versus expectations, which were for minus 1%. So companies continue to announce results that at least versus the published analyst models are doing quite well. I think that in this particular earnings cycle, though, there's just a lot of focus on the Fed and what they might be out there doing. We've talked a lot of this year about the sort of teeter-totter that we're on between the economy being too strong and the economy being too weak. Certainly throughout the month of October and really September, we got a lot of data that would suggest that the economy was running very strong and, in fact, culminating in a GDP print for the third quarter that was up in the high fours. And an inflation rate month over month that just is staying at that kind of 0.3 level and not coming down. This really, I think, ignites this debate about whether or not the Fed is going to need to stay higher for longer. And, I think that all eyes are on the Fed. They meet tomorrow to announce a rate decision. It's widely expected that they will pause. There's certainly, if we look in our rear view mirror, there's certainly a lot of strength in the economy. If we look in our forward viewing mirror, or it's not really a forward viewing mirror, if we just look out the windshield, you'd see a little bit of dark clouds on the horizon. Consumer confidence just came in at about a 5-month low. As consumers are a little concerned about that inflationary number. And we have seen the Fed comment that higher long-term rates may slow the economy down a little bit, certainly with the 10-year up at about 4.85%. That puts pause on a lot of longer-term projects, and that may give the constriction that the Fed is looking for. So once again, just a very focused, all eyes focused on where we're going with interest rates. Right now, the expectation is that they kind of stay high for a very long time, and maybe we're talking about lowering into mid to late 2024. Although if we get a little bit of economic weakness, then all bets are off in terms of how fast the Fed might move in the other direction. So with that, as always, if you have any questions, please reach out to myself or to your advisor. I look forward to talking to you again soon, and I hope you're having a great day.